Welcome to another accounting video, and today ACCN2 Jan 2013 question 2. This is essentially just a really simple income statement for 24 marks. So if you're given a question like this, it's a bit of a godsend really, because when you break the additional information down, work through it one by one and just put the data you've got into an income statement, it's really hard to get a question like this wrong. So I recommend, as I said, just going through each of these one by one, all 7, listing them, and then going into your income statement, putting in the data that you're already given, plus and minus any changes you have to make. So I think just simplifying it for yourself and taking your time with these sort of questions is the best approach, and it's very easy to see where you've gone wrong if you do make a mistake. So we'll go straight on to the first additional information, so working 1. Included in the revenue figure is £8,400 for the sale of goods that have been sent to customers on a sale or return basis. The sale of goods has not yet been confirmed. The gross profit markup on these goods is 100%. So I think the most important thing to take there is sale or return basis. So we have given these goods to the customers in the hope that they sell them, but they haven't sold them, so they've returned them. So we need to take that 8,400 out of our revenue, simply because we haven't sold the goods yet, and we shouldn't just anticipate sales, because then you could make up any old figure and just say this is revenue, add it in. So it's sort of being prudent in a way. So I'm going to take my sales, I'm going to lift the figure from here, which is 208,900, and I'm just going to take away the 8,400, which is the sales value to us. So assuming we've done this, we've taken out of our sales. So what we've done is we've got our company and the customer company, so the goods have returned to us. So not only have our sales decreased, but we've got more goods now, so obviously we've got more inventory. So closing inventory is going to be our figure from here. So inventory at the 30th of November 2012, so 9,560. We've got more goods now. So here I've open bracket Y, because the sale of goods, because the gross profit margin is 100%. So the cost of these goods to us is not 8,400, it's actually half of that. Because when you do a gross profit markup of 100%, you're just doubling the price essentially. So you just do 8,400 over 2. So our new inventory figure is 13,760. So easy as that really. Working 2. So included in the inventory valuation at the 30th of November 2012, so that's the closing inventory, we've just dealt with it, are goods that initially cost 2,600. The goods have been damaged and will need to be repaired at a cost of 630. They can then be sold for 2,850. So this is just a classic cost versus net realizable value question. So we're going to calculate both of these, see what the lower is, and then adjust our closing inventory accordingly. So the cost is 2,600. Net realizable value is very simple. It's just the selling price after the repairs minus the cost of the repairs, which brings me to 2,220. So they're originally valued at this cost figure, and they're actually worth this to us now. So they've gone down. So our closing inventory figure needs to go down by 380. So that's simply 2,600 minus 2,220. So we're going to edit our closing inventory yet again. So don't forget to take it from your previous adjustment, and we're going to take off this 380 to give us 13,380. So I'd probably just put a star next to there now, just remind yourself not to put this figure in here, but to put this figure in your income statement. If you did put that in, you probably wouldn't lose 2 marks, because you've shown you know what's happened and you know how it works. It's just you've misread it, which is not a huge thing as long as you understand what you're doing and the context around it. So Richard, who owns the business, has taken out some goods for his own use. they cost 588, and they sell for 1176. So that shows the 100% markup, because double that does equal that. This transaction has not been taken into account, so this is just goods taken for own use. And when there's goods taken for own use, you just take it out of purchases. It's as simple as that. So we need our purchases figure, which is 100,800, and we take away the cost, because that's what they're valued at in our accounts. They're not, inventory is valued at cost, not selling price. So you can see we've taken it out of purchases, but what's the opposite transaction to that? Well, it's drawings, isn't it? So we've got the opposites again, balance each other out. We've taken out of purchases and we've increased drawings, so they'll cancel each other out. You can also think of it in a different way, in terms of it will increase your profit but also increase your drawings. So in your balance sheet, the equity section will go up because there's an increase in profit, because we've got a smaller cost of sales, therefore bigger profit. But we've also got bigger drawings being taken away from that, and it'll be the same 588 figure, so it'll balance. Sometimes it's just good to think of it in two different ways, just to confirm to yourself that you're doing what you're doing makes sense. So interest receivable due but not yet paid by the bank, so this is accrued income. So we've got interest received already in the information at the top of £480, and we're due some income related to this financial year, so we just add it on. So just like an accrual, if we're paying something late, we need to add it into this financial year to take into account. W5, Richard received a cheque from Cole Sports for an amount. The balance on the Cole Sport account was 580 written off, but now we've received it. So we initially had a trade receivable. They went bad, so that's a bad debt, an expense, and then we've recovered it. So again, an income, however you like to think about it. So bad debt recovered is 378, the cash we've received. So sometimes you might think, well, we've received 378 of the 530, why don't we anticipate the rest of it once we've subtracted 378 away from it? Sometimes it's just good not to do that, essentially, because you're being prudent. Just because you've received one part, you shouldn't just assume you're going to receive the rest of it. So this is listed as an other income, so you just add it to the gross profit, just like you would with interest received. So you do that for both. W6, really simple, classic point question. Depreciation is to be provided on non-current assets using the reducing balance method at a rate of a third, 33.33%. So how do we do this? So reducing balance is always the cost, so 27,000 minus the depreciation to date, then the balance, the percentage it gives you. So you can divide by 0.3333 recurring, but it's just easier, just times by a third, and you get 6,000, which seems reasonable, no silly decimal. So yeah, that's just going to be a basic expense. And W7, the provision for doubtful debt is to be maintained at 5% of trade receivables. So I think a lot of the time when you get asked to do a doubtful debt calculation, you may have edited your trade receivables earlier on, but we haven't edited our trade receivables at all, so we don't need to look out for anything. We can just lift the trade receivable figure from here. So our doubtful debt equals our trade receivables times by 0.05, 5% basically, 940. So our provision for doubtful debts was 680 for last year, so it's gone up, so it's increased, so it's an expense. We've increased our provision, and any increase in the provision is an expense. So 940 takes 680 equals 260. But that was an expense. So say if it was the other way around, say if it was 940 last year and then 680 this year, it would be an other income alongside bad debt recovered and interest received. so we just add it to the gross profit. As simple as that, really. So we've done, I'd say this is the hard bit done. We've done all the calculations, we've done all of the backroom stuff for the income statement. Now we just need to present it with the information we've already got and just make sure we don't put any silly numbers into calculators and we just get the answer correctly, really. So I've already written the skeleton of the income statement just to save you and me time. So sales W1 200,500. So I can just take that straight from my own calculation. Opening inventory we didn't edit, so we can just take 12,780. Purchases we did edit in W3 to take into account that the goods taken for own use, so 100,212. So as you see, it's just lifting the figures from the information they give you and the figures you've calculated yourself, so it's not really challenging in any way or problem solving in any way. 13,380. Don't forget to take that away from your cost sales, don't add it. Many times I've made that mistake. 99,612. Brilliant. Okay, so we can calculate our gross profit upon that. 100,888. So as I said earlier, we have two things we need to add to gross profit. That's interest received and bad debt recovered. Bad debt recovered. So we've got 600 and 378, and that is 101,866. Okay, so we have two expenses I've already listed here because they come up basically every year, and most of the time you won't even need to adjust it unless it's like a basic accrual or prepayment. So I'm just going to list the figures from the question. It's not hard to see how I've done this, to be honest. And two other expenses, the depreciation we calculated in W6, just bring that up there, which came to 6,000. Where is that? It's just there. And then this provision, so I'll just put doubtful debt, which came to £260. Total expense 97,155 for a gross profit of 4,711. So that's it, really. As I said earlier, just break down the question very simplistically into the additional information, list them here, and then go into your income statement. If you want to give yourself any more peace of mind, sometimes what you can do is just put in your little income statement references to how you've calculated them. So say if an examiner's looking through it and they think 600, how has he or she got that? W4 cross references back to here. Oh, that's how he or she got it. If it's wrong, they might give you a mark because they've looked at it and thought, yes, they've got the right method, but they've got the wrong numbers or a miscalculation. But you know, every mark's worth it, so make sure you put your method down and all your workings, really. But besides that, I've not got much else to say. Besides, I'll see you in the next video, and best of luck with everything that's going on.